There is an old axiom in the intelligence community that has saved more lives than any satellite feed. The loudest threats are rarely the most dangerous. The enemy screaming at the gates is a distraction. It is the quiet one, the one standing perfectly still in the corner of the room, that you need to fear. In financial markets, we are conditioned by the media to look for noise. We are trained to hunt for the massive green candle that shoots to the moon, signaling euphoria. We look for the violent red crash that signals panic. We are addicted to volatility because volatility looks like action. But right now, if you pull up the silver chart and look at the low $60 range, you see something terrifyingly strange. You see nothing. The price is stuck. It churns. It dips a few cents, creating a momentary illusion of weakness, and then it bounces back. It rises a few cents, and then it hits an invisible ceiling. To the average retail trader, watching this price action is like watching paint dry. It looks like boredom. It looks like the rally has stalled. It looks like the market is confused and directionless. But if you look deeper, if you peel back the superficial layer of price and look at the volume, you are not seeing boredom. You are seeing a war zone. Over the last few trading sessions, billions of dollars of paper leverage have been thrown at this market. Bullion banks have shorted into the rally. High-frequency algorithms have dumped positions to trigger stop losses. And yet the price refuses to break. It refuses to flinch. Why? Because someone is standing there. Someone massive. Someone with pockets deeper than the bullion banks and a time horizon longer than any hedge fund. Someone has placed a limit buy order so large, so mathematically precise, that it is absorbing the entire global supply of silver without moving the price by a single cent. We are witnessing the arrival of a mega whale. This isn't a Reddit squeeze driven by emotion. This isn't a macro hedge fund trying to make a quarterly bonus. This is a strategic buyer accumulating a position that will shift the balance of global power forever. To understand what is happening in this $63 range, you have to unlearn everything you know about how retail traders buy. You have to understand the mechanics of smart money. If you or I want to buy silver, we log into a brokerage app and hit Market Buy. The price ticks up slightly. We get our shares. We are happy. But if you want to buy $650 million worth of silver, roughly 10 million ounces, or the entire output of a major mining district, you cannot just hit Market Buy. If an entity of that size executed a market order, the price would not just tick up, it would gap. It would spike to $100 instantly. You would slip yourself to death. You would ruin your own entry price and alert the entire world to your intentions. So, what do? You use the weapon of the institutions, the iceberg order. An iceberg order is a special algorithmic trade designed to hide size. It places a tiny visible order on the public books, say 5 contracts. But hidden underneath, submerged in the dark pool exchange data, is a massive order for 50,000 contracts. Every time a seller hits the visible 5 contracts, the algorithm instantly reloads them from the bottom. Sell 5, reload 5, sell 5, reload 5. The price doesn't move. It stays pinned at your limit price like a magnet. But the volume meter spins like a turbine engine. The sellers look at the screen and think there is infinite demand at that level. They eventually run out of ammo. They panic. And once the sellers are exhausted, once the liquidity is drained, the whale removes the wall and the price teleports upwards. This is exactly what we are seeing right now. Look at the chart in the $63 zone. Every time the banks try to smash the price down to cover their shorts, it hits an invisible concrete floor. It doesn't bounce, it just stops dead. That stop is the whale's mouth opening. We estimate, based on the volume turnover in the last 48 hours, that a single entity has absorbed roughly 10 million to 15 million ounces of silver. That is between 650 million and 1 billion in capital deployed in days. Who has that kind of cash? Let's look at the suspects. It isn't a standard hedge fund. Hedge funds are terrified of commodities and prefer the casino of the stock market. It isn't a retail mob. The retail investor is tapped out by inflation. It isn't a bullion bank. Banks typically sell into rallies to manage their risk. They do not defend floors with their own capital. This footprint belongs to a strategic corporate entity. This is a company that needs the metal not to trade, not to hedge, but to survive. A company that views $63 silver not as expensive, but as cheap insurance against extinction. We are watching the accumulation phase of the century, and the longer the price stays flat, the more violent the explosion will be when the whale is finally full. What we are witnessing in this consolidation zone is a historic handoff. It is a transfer of ownership from weak hands to strong hands. Let's define the players. The weak hands are the speculators who bought at $50 hoping for a quick flip. They are nervous. They see the price stalling at $63 and assume the bull run is over. They are terrified of a crash. Every time the price dips, they panic and sell. They are providing the liquidity the whale needs. The strong hands are the buyers. They are not nervous. They have a 10-year time horizon. They are buying the panic. This process, where volatile investors exit and long-term strategic hold. If you just watched part 1, you know the who. You know that a massive strategic buyer, almost certainly a tech giant, is absorbing every available ounce of silver at the $63 level. You know that this buying is calm, algorithmic, and relentless. But now, we must answer the why. Why would a software company care about a precious metal? Why would Microsoft, Google, or Amazon be secretly accumulating silver bullion? They aren't building jewelry. They aren't minting coins. They are building the brain. We are in the early innings of the artificial intelligence revolution. Wall Street is obsessed with the chips, the Nvidias and the AMDs, but they are ignoring the lungs. AI doesn't breathe air. It breathes electricity. You have heard the phrase, data is the new oil. That is a lie. Data is the internal combustion engine. The oil is electricity, and we are running out of it. Let's look at the physics. A standard Google search uses roughly 0.3 watt-hours of energy. A ChatGPT query uses roughly 3 to 10 watt-hours. That is a 10x to 30x increase in energy density per click. And as the models get smarter, as we move from large language models to artificial general intelligence, AGI, the energy consumption goes exponential. The grid cannot handle it. The US power grid is old, fragile, and already maxed out. The data centers in Northern Virginia are already being told there is no more power available. So the tech giants are facing an existential crisis. They have the chips, they have the software, they have the customers, but they do not have the power. This forces them to do the unthinkable. They must become their own utility companies. You don't have to guess what the whales are doing. They told us. We just weren't listening to the right frequency. In late 2024, a partnership was announced that changed the world, yet barely made the nightly news. BlackRock and Microsoft launched a $30 billion artificial intelligence infrastructure fund. Read the fine print. What is AI infrastructure? It isn't just servers. The press release explicitly stated, to build data centers and the energy infrastructure to power them. $30 billion. Let's put that number in perspective. The entire annual global mine supply of silver, every ounce dug out of the ground in Mexico, Peru, and China combined, is worth roughly $25 billion. This one fund has more capital than the entire annual production of the silver mining industry. And that is just Microsoft. Amazon has committed billions to renewable energy. Google has committed billions. Meta has committed billions. They are sitting on a combined war chest of over 100 billion dedicated solely to building power generation. Here is the catch. They have all made public commitments to be carbon negative or net zero by 2030. They cannot build coal plants. The PR would destroy them. They cannot build natural gas plants. Regulators won't allow it. Nuclear takes 10 years to build. They need power now. Wind is unreliable. You can't run a server farm on a breeze. That leaves only one scalable, deployable, carbon-free energy source that can be built in 12 months. Solar. They need solar, not a few rooftop panels. They need gigawatt-scale solar farms covering entire counties to power their data centers. And as we established in previous investigations, you cannot build a high-efficiency TOPCon solar panel without silver. It is the most conductive element on the periodic table. It is the only material capable of moving electrons fast enough to make solar viable. So do the math. If Microsoft plans to deploy $10 billion into solar infrastructure, and silver makes up roughly 10% of the cost of a solar panel, that is $1 billion of direct silver demand from just one company. That matches our iceberg order perfectly. The $650 million accumulation we are seeing at 63 isn't a hedge fund speculating on price. It is a procurement department. It is Microsoft, or a proxy acting for them, securing the raw materials to ensure their $30 billion investment doesn't fail because of a silver shortage. They are buying the silver paste before they even build the farm, because they know if they wait until the farm is approved, the silver won't be there. But wait, the skeptics say. Solar panels are getting more efficient. They use less silver per watt. This is bearish for silver. This is true. The thrifting is real. Engineers are trying to use copper. But this triggers the Jevons paradox. This is an economic rule dating back to the 1800s coal industry that states, as technology increases the efficiency with which a resource is used, the total consumption of that resource increases rather than decreases. Why? Because as solar becomes more efficient, it becomes cheaper and more powerful. Because it is cheaper, we build more of it. We don't just put it on roofs, we put it on cars, we put it on windows, we build massive farms in the desert. The efficiency gains in silver usage are being completely overwhelmed by the volume explosion, especially with AI. An AI data center runs 24/7. It requires baseload reliability. To run a data center on solar, you can't just build enough panels for the daytime. You have to overbuild the solar array by 3x or 4x to charge the massive batteries required to run the center at night. For every gigawatt of AI compute power, you need 4 gigawatts of solar capacity. This multiplier effect is the silver killer. The tech giants know this. They have run the simulations. They know that net zero AI is mathematically impossible with the current global silver supply. So they have 2 choices. Option 1, abandon AI. Not happening. Option 2, corner the silver market. They have chosen option 2. They aren't trying to squeeze the price. They don't care about the price. To Microsoft, $100 silver is a rounding error. To them, silver is just a construction material, like concrete or steel. They just need availability. This marks a shift in corporate strategy that we have. If you have been following this investigation, the picture is becoming terrifyingly clear. We have identified the whale at the 63 low level. It is the AI industrial complex. It is the combined force of big tech and global energy, securing the physical silver needed to build the grid of the future. They have a war chest of $100 billion, a mandate to reach net zero, and they are currently absorbing the global float of silver through massive silent iceberg orders. But here is the question nobody on Wall Street is asking. What happens to everyone else? The silver market is a zero-sum game. There are only about 830 million ounces mined every year. It is a pie that does not grow. If Microsoft, Amazon, and Samsung suddenly demand an extra 200 million ounces to power their AI revolution, that metal has to come from somewhere. It has to be taken away from someone else. In economics, this is called crowding out. When a giant enters the room and sucks up all the oxygen, the smaller creatures suffocate. We are going to look at the collateral damage of this accumulation. We are going to expose the industries that are about to be starved of silver. We are going to look at the medical crisis and the military panic that this shortage creates. The tech giants are eating. Everyone else is about to starve. When we talk about silver, we usually talk about money or solar panels. We forget that silver is a critical component of warfare. Consider the Tomahawk cruise missile. It is a $1 million weapon designed to fly 1,000 miles and hit a window. To achieve that precision, the guidance systems and batteries require the highest conductivity possible. You don't use copper in a hypersonic weapon. You use the best. Silver zinc batteries are the heart of torpedoes. Fighter jet cockpits use silver-coated glass for stealth and de-icing. Satellites are wired with it. Here is the problem. The military-industrial complex is price inelastic. The Pentagon cannot say, silver is too expensive at $100, let's build cheaper missiles using aluminum. That is how you lose a war. They must have the metal, regardless of the price. So what happens when the tech whale sucks up the inventory at $63? The Defense Logistics Agency wakes up. The procurement officers at Raytheon and Lockheed Martin wake up. They realize their just-in-time delivery is late. They call the refiner. The refiner says, "Sorry, Samsung bought it all." This triggers a bidding war. But this isn't a bidding war between speculators. It is a bidding war between national security and technological supremacy. The U.S. military has priority. They can invoke the Defense Production Act. They can legally seize the silver supply chain before it ever gets to Apple or Microsoft. But Apple has the cash. Apple has the forward contracts. Apple has the political influence. This clash creates a vacuum upwards. If the military seizes the supply, the tech giants have to bid higher for the remaining scraps on the open market. If the tech giants secure the supply, the military has to pay a massive premium to divert it. This is the definition of collateral damage. The tech whale didn't intend to start a crisis in the defense sector, but by hoarding the float to build their AI grid, they have inadvertently squeezed the most sensitive industry in the world. As an investor, you need to understand this. You are not betting on a bubble. You are holding the only asset that Raytheon, Pfizer, and Microsoft are fighting over. That is a very safe place to be, and it isn't just missiles, it is medicine. We forget that silver is the most antimicrobial element on the periodic table. It kills bacteria on contact. It is essential for modern healthcare. It is in burn creams to prevent sepsis. It is in catheters to prevent infection. It is in surgical tools and water purification systems. Like the military, the medical industry is price inelastic. A hospital cannot substitute plastic for silver in a burn ward. People die. So when the supply tightens, the medical procurement networks will panic. They will pay any price. And this panic buying adds another layer of buying pressure that has nothing to do with the COMEX price or the Fed's interest rates. It is driven by necessity. So if tech, military, and medicine must have silver, who stops buying? Who gets crowded out? Jewelry and silverware. This is the discretionary sector. India consumes a massive amount of silver for anklets, bracelets, and so how do you play this? You are not a whale. You do not have $30 billion. You cannot move the market. If you try to fight the whale, you get crushed. If you try to front-run the whale, you get shaken out by volatility. The winning strategy is to draft. In auto racing, drafting means riding in the slipstream of a larger vehicle. They cut the wind resistance for you. They burn the fuel. You use less energy to go faster. The iceberg order at $63 is your semi-truck. The whale is spending billions to defend this level. They are absorbing the selling pressure. They are building the floor. Your strategy is simple. Number 1, don't get bored. The whale wants you to get bored. They want the price to stay flat, so you lose interest and sell your shares to them. Boredom is the trap. Number 2, buy the base. Every time the price touches the bottom of this consolidation range, 63, you buy. You are buying with the whale. You place your stop loss just below their iceberg. If the whale leaves, you leave. But as long as they are there, you are safe. Number 3, watch the volume. As long as volume remains high and price remains flat, the accumulation is happening. When volume drops, the whale is full. That is when the fireworks begin. If you are buying physical silver, where do you put it? The whale isn't using the COMEX warehouses. They aren't using bank safety deposit boxes. They are using private, non-bank vaults in neutral jurisdictions. You should do the same or hold it yourself. So, we know the whale is there. We know they are eating the supply. But an iceberg order cannot last forever. Eventually, the sellers run out. Eventually, the whale fills their bag. Eventually, the limit buy order is removed. What happens in that exact second? The vacuum. When the massive buy wall at $63 disappears, and there are no sellers left because the whale bought them all, the price doesn't tick up. It teleports. It jumps from $63 to $65 to $68 in minutes. This is the release of the coiled spring. In this final chapter, we are watching the transition from the boring phase, accumulation, to the violent phase, markup. Let's look at the volume profile of silver. This tool shows us at what price levels the most trading has occurred historically. We have built a massive base of volume in the 20s. We have now built a massive base of volume in the low 60s. But look above 65. Look at the chart history going back to 1980 and 2011. Price spent almost no time in the 70s or 80s. It went up through them instantly, and it crashed down through them instantly. This creates an air pocket. There are no bag holders at $75 waiting to sell to get their money back. There is no overhead supply. There is no institutional memory of price action there. This means there is zero resistance. Once the price clears the gamma wall at $65, it enters a vacuum. In a market vacuum, physics changes. A small amount of buying force creates a massive amount of price movement. If the whale buys 1 million ounces at $63, the price moves 10 cents. If the whale buys 1 million ounces at $68, the price might move $5,000. Why? Because there are no sellers. The sellers have been cleaned out. The only people left holding are the diamond hands who want 100 plus. This is why the markup phase is so violent. You will wake up one morning and silver will be up 4, and you will go to lunch and it will be up another 3. The media will scream bubble. But it isn't a bubble. It is price moving through a vacuum to find the next area of liquidity. And according to my analysis, the next major area of liquidity is the inflation-adjusted high of 1980, which is well above $100. Before we pop the champagne, I need to give you a warning. The banks know about the vacuum too. They know that if $65 breaks, their short positions die. So just before the breakout, we often see one final, nasty move. The stop run. Just before the price rips, it might dip sharply one last time. It might drop from $63 to $61 in 5 minutes. Why? To trigger the trailing stop losses of the retail traders. To shake out the last weak hands who are nervous. To verify that there are no more sellers left. This is the springboard. If you see a sudden, inexplicable drop in the next 24 hours, do not panic. Look at the volume. If the price drops on low volume, it is a trick. It is a head fake. The whale is checking the fence for holes before they release the bull. If you sell into that dip, you are handing your winning ticket to the conductor right before the train leaves the station. The hardest thing in investing is not buying the bottom. It is holding the winner. When silver hits $70, you are going to feel like a genius. You are going to have massive paper profits. And your brain, your reptilian brain, will scream, "Sell! Take the profit! It might go down!" This is the most dangerous instinct you have. Because you are thinking in terms of fiat profit. You are thinking, I made $10,000. But you are measuring your wealth in a currency that is collapsing. If you sell your silver at $70, what do you get? You get dollars. What are you going to do with those dollars? Buy overvalued stocks. Buy bonds with negative real yield. Keep it in the bank where